Hi, my name is Richard Hutton and welcome to the Exponential Fund, the place where you learn to invest and absolutely crush average market returns. Well, we wrapped up another month and it was a good month. I would say that it is possible that the bottom is behind us. I should trademark that sentence. So let's recap last month's performance. So the S&P 500 went up 9.2%. Very nice. And my portfolio, the Exponential Fund, went up 6.59%. So it is less, but there's a specific reason for the underperformance, especially in the last few weeks. And that is because on eToro, they give us a risk score from 1 to 10. And because I'm in the popular investor program where people can copy me, I must comply by certain rules, risk parameters. So my risk score must be a maximum of 6. Now, because of this great crash, it did go up to 7. And temporarily they blocked me from getting new copiers. So I'm like, okay, we are in the depths of this crash, and still the companies that I invested in keep growing their sales and profits, right? Even though overall the US economy is declining, but the companies that I'm investing in keep growing. And thus I have interpreted that as a great buying opportunity. So in order to allow people to take advantage of this, to be able to copy me, I'm like, okay, let me trim my positions a bit so I have some cash, and thus my risk score would go down. And it did, right? I had to trim 30% of my positions to keep 30% in cash, and my risk score went down to 6. Cool. So then the market went up, so my portfolio went up less. Since then, I have started to buy back some of the stock, right? Just slowly to make sure that my risk score doesn't go too high, right? In normal conditions, I can have, the entire portfolio invested and my risk score is not 7. It's just this exceptional period of high volatility. All right. So as I said, we are officially in a recession, 2 consecutive quarters of negative GDP. Well, actually, it may not be that official because the White House changed the definition of a recession. So there's that. Now, if we are in a recession, how come the markets went up so much? Well, the markets are forward-looking, right? The markets have started to decline, severely in November. And then we had Q1. And then we got GDP numbers for Q1. And indeed, the economy declined. And then stocks continued to drop. And then we wrapped up Q2. And then we got Q2 GDP numbers, and indeed it was a drop, right? And now what the market could be saying is the worst is behind us. We are past peak inflation. Oil prices have come down. A lot of commodity prices have come down. Supply chains have eased. Okay, not completely back to normal, but it's not getting worse, right? It's getting better. So, as I said, the biggest gains often come after the biggest crashes, right? Because there's peak fears, everybody like panic selling at once. And then when all of the sellers are gone, it just rallies back up. So, 9% up in the S&P in a month. That's very good. You rarely see that, okay? To put in context, The S&P 500 on average goes up about 8% a year. And last month, the S&P went up 9%. So that's quite a bit, you know? Cool. Now, just as a perspective, are recessions bad? Well, I have a problem with judging things as good or bad because it's simply a matter of perspective, right? So if a dictator gets killed, some people might be devastated. Some people might be upset. Some people won't care, and other people will be happy, right? So there's a wide range of, reactions to the same event. So it's not that an event itself is good or bad. It's more about your perception, right? So is a recession bad? Now, let's make something very clear. Recessions are not pleasing, they're not fun. There's a lot of suffering involved, but there can be some positive outcomes from a recession because, as Elon said recently, if good times last too long, people become complacent, right? They believe good times will last forever. They take on too much debt. They become negligent with, their costs. People become way too optimistic and they start risking money on companies which really should not receive either not that much capital or at all, right? So, a recession is a reset, right? That's what I was saying before. Overall, the economy in the US declined, but the companies that I invest in, the 20 companies in the Exponential Fund, if you don't know, they are the 20 largest companies that have been growing their sales by at least 10% every year for the last 5 years. So big, fast-growing companies. Okay? They have grown, right? So, the great companies are not affected or not affected as much, right? Now, the rules of my strategy are intentionally mechanical, meaning they're completely definable mathematically, right? It does not take any personal discretion to invest according to the rules of the Exponential Fund. And this is by design. I wanted to make it as easy as possible to execute a strategy. So, for one thing, I can easily teach it to others. Also, if and when I have kids in the future, let's say they don't want to, pursue investing as a career, but I still want them to be able to invest. Well, with the Exponential Fund, it is possible to allocate just, an hour once a year, and you'll probably make a lot of money, So that's why, I am making videos regularly just to, check up, give my opinion, so and so. But it's not like I have commented like, oh, we have found out this new piece of information. Oh, because inflation is 9%, now I will do this trade. No, like my trades, my investments have nothing to do with the macro environment. I will sell one of the stocks in my portfolio if that company grows its sales by less than 10% in the previous year, right? So right now it's August 2022. If, we see in the beginning of next year, let's say Netflix posting their annual report, and if I see that in 2022 they grew sales by 9%, I'll sell, right? I don't give a fuck what else. I don't care explanations why. I don't care their future plans to get back on track. No. One bad year and you're fucking out, right? I want companies with a perfect track record, right, of growth every year, recession proof, right? The clean S curve. In other notes, I recorded a webinar. Well, I held a webinar and recorded it. And now this one is in Romanian, and I titled it How to Become Financially Free. So if you know Romanian and haven't seen it, I posted it on my channel, so just go check it out if you want. It's an hour long and essentially explains my whole thought process of how I came up with the exponential fund, start to finish in easy language. If you have people that might be interested, hey, go ahead and share. It's good stuff. Now, for a quick lesson on concentration versus diversification. So, traditional investment wisdom says you should diversify, right? To lower the risk of your portfolio, diversify. Okay, let me give you an example. Which is more risky? To have all of your money in a single company, or to have your money invested in 500 companies? I'll give you a second to think about it. And the answer is, it depends on the company, right? Now, let me give you a specific example. As I said, we are unofficially in a recession. In the last 12 months, the S&P 500, the great market average, is down about 5%, right? In the same period, Tesla stock is up 30%. Well, how about that? So which is more risky, right? Now, if you just run through this experiment, just mental exercise. Take all of the companies listed on the US stock exchange and sort out only the ones that are larger than 10 billion in market cap and that have been growing their sales by at least 10% every year for the last 5 years. You get down from the thousands of companies, you get down to about 80, 82 to be exact. Okay? Now, take those 82 companies, sort them from largest to smallest, and just, number them. Biggest, Microsoft number 1, second biggest, number 2, and so on and so. So this is what I call the, size score, right? In the next column, write down the sales growth for last year and sort them by sales growth. So the fastest growing number 1, second fastest growing number 2, and so and so. This is their growth score. Now add the two scores up, right? Their size score and their growth score. And you get the total score. And if you rank the companies by the total score, the one with the smallest number, right, would be the company at the intersection, the company that's the largest company that's growing the fastest, right? So, I've used this example many times, but if you haven't heard me say it, without knowing what that company is, we could say that company is pretty special, right? I mean, we went to the largest economy in the world, the US, then we looked at the companies that are listed on the stock exchange, which is already a big fucking deal, right? Because there's millions of companies and just a few are listed. Then out of those companies, we looked at only the ones that are larger than 10 billion, which is already a very big deal. Have you built a $10 billion company? Right? I haven't. So it's already a big deal. Then we looked at the ones that are growing consistently very fast. And then we looked at the absolute top one, largest, fastest growing. That's a pretty special company, right? I agree. Well, surprise, surprise, that company is Tesla, right? There is no other company at a market cap of $900 billion that's growing at 70% per year. And that's revenues. Profits are growing way faster than that, right? So when you make an investment, all you care are two things: how much risk and how much reward. Now, obviously, nothing I say is financial advice. I'm definitely not advising you to invest in Tesla. You do your own research, right? I invested in Tesla, but I could be wrong, you know? If you care only about risk and reward, there are many factors that lead into risk. But one aspect is simply the size of the company, right? The larger the company, the lower the chances that they'll just fucking go bankrupt next year, right? Cool. The second part, growth, opportunity, you could simply look at the trajectory, the trend, right? A simple law of physics is inertia. An object in motion tends to stay in motion. So a company that has kept growing their sales year after year after year for a long, long time, I mean, goddamn, just statistically, what's the chance that exactly this will be the year when they'll suddenly stop growing? I mean, if you take a bunch of these companies, it's probably, maybe some will stop growing this year, but not the majority, right? I would say yes. So put these two together, just big, fast-growing companies, and you might have on your hands a pretty good strategy. Now, it's not perfect, it doesn't take into account sector diversification, valuation, macro environment, blah, blah, blah. But look, you can't just have all of the variables, right? That's... If you tried to, predict the universe, I'm not playing God. I just want to make money in the markets, okay? Write that down. That's a quote. So that's the thing. Diversification versus concentration. Buying a bit of everything, and you'll get the market average returns, right? We're in a recession. Well, my portfolio is down. Okay. Versus Tesla, which is, I believe, a phenomenal company. There's no other company this large that's growing this fast. And during a recession, it's way up, like 30%. Jesus Christ, that's a very good return, right? So, think about it. All right. Thanks for watching. Till next time.